right. All right, everyone. Welcome to Making Multifamily Money. Thank you for hopping onto this call. It's a pretty small group to start off with, but to start, I just want to share my presentation I created about my 20-unit apartment complex. I actually recorded it prior, but I forgot to hit record. So I decided to save it for this session. So let me hit share. Cool. So can you guys see my screen okay? Okay, cool. All right. So thank you again for hopping on. For those of you who don't know, I'm Steven. I'm a full-time pharmacy director. I still work full-time. I currently own 90 units of real estate based in California, which is a high cost of living market. I own about 5 single-family homes. I own 2 apartment complexes in Oklahoma. So one's a 26 unit and in my 20 unit, which I'm going to talk about today. And I own a mobile home park, which I'm currently in the process of selling in Alabama. So collectively, I own 90 units. I don't have any partners. I purchased 90 units in about 5 years while working full time. And I did it just, gradually over time. So that's just kind of a high level about me. So let's just get started. This is why everyone's here. So I want to talk about my 20-unit apartment complex BRRRR. So this is kind of a case study. I'm kind of going over the timeline of, how I bought it, what my strategy was, and kind of what my exit strategy, which I'm currently doing right now. So here, let's talk about the deal. So I got this off market via direct mail. If you've been following me for a while, I'm pretty big on direct mail. I use PropStream to get my data, and I use a company called Yellow Letters Complete to do my direct mail campaign. If you want links to that, you can reach out to me directly, or when this video is uploaded, just click check down below. Typically, I'll have my referral links. But what I did was I sent out 300 letters a month for about 6 months. So that's around 1,800 letters. It costs roughly $1.50 per letter. With inflation, it's probably around $1.80 a letter today. And what I did was I just basically pulled lists from PropStream and hit all of Oklahoma. And through my 1,800 letters, which costed me around $3,000, I was able to get 2 off-market apartment complexes. One was my 26 unit and one was my 20 unit. I worked direct to the seller. No broker was involved. And I basically bought each of my apartments with instant equity day one. So on my 20 unit, I actually bought it with $50,000 of equity day one. So I bought it for $350,000, which is really cheap, right? That's about $17,000 per door. I mean, I'm from California. I can't even buy a condo for $350,000 for some context, right? So to me, it's cheap. And when I first bought it, it had about 15 out of 20 units occupied. It had around $5,000 in gross rents day one. And there's one unit that burned down. And what was kind of funny was the unit burned down 5 years ago. It was because of a kitchen grease fire. And the owner was too cheap to repair it and fix it, that he just left it as a burned down unit for 5 years. So he literally did nothing. So, when you kind of go off market and you have motivated sellers, you're gonna have a lot of deferred maintenance. And this is very common, right? Like sometimes the owners, they don't have, $40,000 to renovate this unit that maybe will give you $550 in rent. So for him, he's like, it's not worth it. And also he didn't buy good insurance, right? Like his insurance basically probably didn't cover the repair costs of that burned down unit. And he probably just decided, it's not worth it to make a claim. It's going to raise my insurance premiums the next year. And he just decided to leave it as a down unit. So, fortunately, this is very common when you're buying value-add real estate. So for me, I see it as an opportunity, right? It's an opportunity to buy it right, buy it with instant equity day one, and have the ability to force appreciation through renovation and raising the rents. So, that's exactly what I did. And kind of going back to the insurance for some context, he spent $5,000 a year on insurance. My insurance is $14,000, for replacement cost insurance, right? So that's the key, is you want replacement cost insurance. And let me admit this person, sorry. And anyways, the other 4 units, they basically needed new flooring. So, it was in decent condition, but they ripped out the carpet. It was due to bed bugs, unfortunately. So they ended up ripping out the carpet. And when I bought it, it just had no flooring, right? So basically it's uninhabitable. And, the seller was very motivated. So I actually sent him a letter, and he actually, I think 4 months later, after I sent the letter, he sent me a letter back saying, hey, I lost your phone number, I lost your email, but I have your address. Like, here's my number, call me. So basically what I did was I called him, and then, sorry. I called him, and basically he said that, I've owned this apartment complex, this 20 unit apartment complex, for around 20 years. And I'm looking to sell because I just want to dump this money into a business that I currently own. Right. So he basically said, he gave me some key nuggets about me asking anything. I owned it for 20 years. What does that mean? That means that this property can be owned free and clear. Right. If he bought this property on a 20-year amortized loan, by year 20, it could be paid off. So that's opportunity for seller financing. And that's how you buy deals with low or no money down, or you can negotiate your own interest rate. Right. This is very prevalent in today's economy with interest rates. I'm getting quoted 7.5% to 11.5%, right, for my properties today. So, interest rates are terrible. And a year ago, I was getting around 5%. So, you can kind of say that I'm a little bit unlucky with my apartment complex because I bought it a year ago. And who would have anticipated that in, 1 year, which is how long I own this, interest rates would double, like from, 5% to 10%. So, this is how a lot of flippers are getting killed. A lot of people doing what I'm doing, they can potentially get killed as well. So, but overall, he was very motivated. And how you can tell if someone's motivated is that, they're very communicative and they're very reasonable in their request. And the owner, he said straight out the gate, hey, I just want to sell this at tax assessed price. And you've been following me for any period or my channel, I always say, if you offer a tax assessed price, you're usually buying the deal with instant equity day one, because it's usually the cheapest model, right? When you make offers for multifamily, it's either price per door, it's going to be net operating income divided by the market cap rate, or it's going to be the tax assessed price. I usually take the 3 and offer the lowest of the 3, and the lowest is always the tax assessed price, right? So that's how I make my offers. Next issue is lending issues. So I had lending issues when I tried to buy the property, and I'm having lending issues as I'm trying to cash out or refinance my property, right? So it never left. And let me share you why. So first, it's a tertiary market. It's rural. The population's around 50,000. It's pretty small. I mean, it's not really small, but not really big either. The loan amount is too small. So remember, I bought this for $350,000, right? Like, most lenders want a minimum of $500,000 for the loan. Also, the rents are too small. I'm renovated. This apartment's only getting about 500 to 550. I'm actually getting around 550. And they don't want that. They want a minimum of 700. The price per unit's too small. Remember, I bought for 18,000 per unit. Some lenders, the minimum is 50,000 per unit, right? So what's the solution? You have to talk to multiple mortgage brokers, and you have to engage a lot of local community banks, right? So I probably talked to, I was buying the deal, at least 10, 11 lenders that all told me no. I just kept on asking until one said yes, which was my hard money lender. And the financing I got was, 25% down. So it's roughly around 80,000. I'm getting $100,000 for renovation. So that's included, right? 9% interest only. So I think my monthly payment is roughly around $2,000 a month, and I'm getting a 12-month term, right? So I bought this in May of 2022, and my loan is literally due on the 12th, May 12th. So like 2 more days. So at the time, that's not bad, right? Like 9% interest only for a hard money loan. I'm getting quoted 10%, and it's not even a hard money loan. So it's crazy how things, change in a year. So let's go into my value add strategy. So, when I bought for 350. It appraised at $400,000 day one, right? So the appraisal report came back at 400,000. So I made $50,000 in instant equity. So this is what I mean by buy right. You want to buy it with instant equity day one, so that if interest rates double on you, like it's doing on me, you at least have, some cushion there. And also the rents. So the prior owner was renting it out for $350 to $400 per unit. I actually have one tenant that I just evicted that is paying $250 in rent, right? So like this is crazy to me. Sorry. So this is crazy to me. In Los Angeles where I live, I have to pay $200 a month just for valet parking, and they force you to valet park. That's like half the rent, right? But after renovation, I can probably get around 500 to 550. And that's what I'm actually getting right now to this day. So what did I do, right? I renovate the units. So that burned down unit, it cost me $40,000. And everything's brand new, like new flooring, brand new kitchen, brand new bathroom, brand new everything, right? So that's how I initially estimated around 30,000 for this renovation of the burn down unit, and it cost me 40,000, right? So things get more expensive, and you always need some cushion, right? And then for the heavy turn for other units that were vacant, it cost me around $10,000 each. Needs new flooring. My 20 units, all one bedroom, one bath. I have a couple of studios as well. So, if you're doing new kitchen, new flooring, new restroom, it's around 10K. The remaining 15 units, I call it a moderate turn. So that's about 4,000 to 5,000 per unit each. So what's a moderate turn? So it might be like new flooring, maybe a fresh coat of paint. You might have to resurface the kitchen cabinets, reglaze the bathtubs, touch up the kitchen vanity. It's more of a cosmetic thing. And what I kind of realized during the renovation was I spent $40,000 to have a brand new unit. I only got $550 in rent, right? Versus a moderate turn unit, which I spent $5,000 to renovate. I still got $550 in rent. So at that point, I was just like, all right, I don't need to overspend on renovation, right? My market doesn't call for it. So don't overspend in your renovation. That's where a lot of beginners mess up on, and myself included. But I rent between my two apartments and my mobile park. I've probably renovated about 45 units in 1 year. My first time, right? As a beginner, right? So I'm almost a high level flipper in just 1 year, right? And then on the outside, I just wanted to repaint the exterior because it was looking a little bit faded. I wanted to make it a little more modern, to show that I'm coming in as a new owner and I want to fix this up. Fortunately, my apartment complex that I bought had a bad reputation. The owner was not fixing things. The rents were low. The tenant base wasn't that great. So this is typical, right? When you buy value add real estate, you're gonna have to turn over all the tenants, renovate it, bring in new tenants. It's gonna take you, 1 to 2 years if you're lucky. At that point, you can stabilize it and then do your cash out refinance. So let's talk about what happened when I took over the property, right? So when I bought it, 15 out of 20 units were occupied. But from my experience, buying mobile home park and another apartment complex, after 1 month of ownership, my occupancy dropped to 7 out of 20. I lost 8 tenants in 1 month, right? And nothing I did wrong. I mean, fortunately, when I took over, there was a bed bug infestation, right? One tenant was letting homeless people, spend the night for a favor. And basically I had to evict him. But once the bed bug spread, you have to fumigate all 20 units, right? You can't just fumigate one unit. If you fumigate one unit, they run to the next unit, right? So you have to fumigate all 20 units. So that costed me $500 per unit to fumigate, which is $10,000 total. And remember what the rents were? The rents are $500. It literally cost me 1 month of rent per tenant just to fumigate my 20 unit apartment complex. So it sucks, right? That's terrible, But remember, I bought this property with $50,000 instant equity day one. So that's my cushion, right? And I forgot to mention that initially the owner wanted $420,000, and I brought him down to $350,000. So I dropped him down by $70,000 in the purchase price. And how did I do that? I forgot to mention that every time a bank rejected the deal, I would give the owner the feedback as to why the deal is rejected. After you tell the owner that you've been rejected by 10 lenders, they start to feel discouraged and want to work with you more. So I even talked to his lender because he set a loan on the property. It was a small loan of like $60,000. And I talked to his lender, and even his lender said, you know what, I don't want to lend on this. There's a lot of deferred maintenance because it's hard to get that owner to do anything. Like we had to beg him to replace the roof for insurance renewal. So, I knew there's a lot of deferred maintenance. So when you have a bed bug infestation, you put notices on the doors. Basically, the tenants have to take everything out of the cupboards, everything out of the closet, put it in the middle, cover it, and it gets fumigated. Well, if you're doing all that work, it's easy just to move out, right? And that's what a lot of people did. They just moved out. And then also, when I take over an apartment complex or anyone takes over, tenants always stop paying, right? You always have a couple that will stop paying, and I have to evict them. In Oklahoma, it's a 15-day notice to evict somebody. So literally, I come in, take over, you put the notices that there's new ownership, they're not going to pay, you give them a 15-day notice, and they usually leave within a week before the eviction date. So they're just trying to take advantage of the situation, right, and save a month's worth of rent, and then move on to the next place and not have an eviction on their record. So that's very common, unfortunately, right, with this type of tenant base. So once I took over, renovation started within 2 weeks of ownership. So, I coordinate with my general contractor, said, hey, I close on May 12th. Can you start in June? He said, yes. So you want to be proactive with that, right? Because sometimes on my 26 unit, it took my general contractor 6 months before he started renovating my property. 6 months of me owning it. That's crazy, right? If you're on a hard money loan, good luck, right? That's half your time. But fortunately, my 26 unit is not a hard money loan. It's long-term loan. But anyways, the property manager actually assumed I want to do heavy rehab in all the units. So occupancy stayed low, right? So occupancy, my property manager, so when I bought the property, remember 15 out of 20 were occupied. I only wanted to renovate 5 units, the 5 that were vacant, that needed heavy renovations. So when occupancy dropped to 7 out of 20, so I lost 8 tenants, the property manager assumed that, those 8 that became vacant, Steven wants to renovate that, despite me telling them multiple times, I only want to renovate the 5. So what I learned from this, you have to constantly remind your property manager of your strategy. Don't assume that they remember because they're managing multiple properties. So that I blame myself, right? That's on me. I should have said, hey, those 8, just get them rent ready and rent them out, right? Because of my assumption, it cost me 1 to 2 months, and maybe I'd be done by now, right? Instead of waiting until the second to last day before trying to refinance out of this deal. So, that's just kind of a lesson I learned, and hopefully you learn from that. But the moment I notified my property managers, they started leasing out units in November of 2022. And for those of you who are new, it's so hard to rent out units in November, December, January. The holiday season is terrible because no one wants to move during Thanksgiving, Christmas, and the New Year. And people that do want to move, they're not going to be your best tenant base, right? So that's the unfortunate news. But I was so desperate because I want to renovate. I have 13 vacant units. I need to rent these out. So what did I do? I offered a move-in special, right? So I offered a $77 move-in special. You pay $77 plus the security deposit, which is 1 month's rent, and then you can move in, right? Great. When I implemented that strategy, I was able to release out 4 units in 2 months. Right? We advertised on Facebook Marketplace. We advertised on Zillow, all those places, right? Well, a lot of property managers don't know is Facebook Marketplace is a great place to advertise. So I always tell every property manager I work with, hey, advertise my unit on Facebook Marketplace. You have to link your personal Facebook account to it, but that's the new Craigslist, right? Everyone's on Facebook. Everyone's on their phone. And once she signed up for it, she's like, oh, wow, you're right. I'm getting so much interest. But anyways, when you offer a move-in special, just know that people will take advantage of the situation. And, I had one tenant move in, and he passed the background check. Everything looked good. He passed income. He had quadruple the income. no bad track record. And, he paid the 77 move-in special. He lived there for 2 months, stopped paying for 1 month, and we evicted him. Right. So, out of the 6 that did the move-in special, I evicted 1. So just expect that. People take advantage of the situation. And I expected it because it's November or December, right? Like, you're not going to get a strong tenant that wants to move during that holiday season. So let's just fast forward to the apartment complex today. So actually, I need to update this slide, but current occupancy, I just talked to my property manager today, is 17 out of 20. That's 85% occupancy as of May of 2023. So we literally leased out, I think, 3 units just in May alone. And this is very common because in May, June, July, August, this is when families move or people want to move, right? So this is the time when it's easy to rent out units. The weather's a little warmer. It's summertime. It's easier to move, right? So at 17 out of 20, it's occupied. And why that's important, because when you refinance, they're going to ask you what your occupancy is. At 70%, you're borderline. At 85%, you're looking good, right? You're looking a little bit better because they assume occupants or vacancy is 10%, right? So if I lease out 1 more unit, I'm at 90%. Hey, that's pretty good. So I actually filled out 13 units of brand new tenants. So basically, I think I only have like 4 tenants from the prior owner after 1 year, right? Rents are now around, it was $7,200, now it's $8,300. So I'm getting $8,300 a month in rent, right? With 3 vacant units. I have 3 units that are rent ready and being advertised. 1 unit that I need to renovate moderately. That one, I'm evicting 1 tenant. So, it was a tenant that I inherited, and he's only paying $250 a month. So, it worked out in a way. But once he leaves, I probably need to renovate his unit for about $5,000. My hard money loan is due May 12th. That's 2 days. And then I spent $120,000 of renovation to date. So let's talk about my refinancing options, right? So a lot of people ask me what banks I'm using. So it's Bank of the West. They financed my 26 unit. Initially, when I presented them the deal, when I first bought it, they didn't like the deal, right? They did not like the deal. My new loan I hope to get is $525,000, 7.25% interest, 7-year fixed, 30-year AM with a prepayment penalty. So 3-2-1, that means the percentage of the loan. So that's pretty good, right? That, about a year and a half ago, I was getting 4.25, 10-year fixed, 30-year AM on my 26th unit. A local community bank would be a new loan at cost. So what does at cost mean? It means that how much I bought it for, $350, plus how much renovation I put into it, $120. My new loan is $470. So it's basically a perfect BRRRR, right? I get back my down payment, I get back my renovation costs. If you look at the terms, 7.5% interest, 5-year fixed, 20-year AM. So not as good, right? Not as good as Bank of the West, but this is common with local community banks. Terms are not going to be as good, but they know the market because they're in Oklahoma. Stride Bank, I'm waiting to hear back from them, but I was quoted 8.5%, 3 years fixed, and 20-year AM. So it's not as good as a local community bank either. And then if I want to extend my hard money loan, which might be my option I have to do, is for 6 months, it's a 1.5% fee of the loan, and they're going to raise my interest rates from 9% to 11.5%, right? So worst case, I can extend it for 6 months. If I think that interest rates may drop in 6 months, I don't know. I wish I had a crystal ball. Like, it could be worse, it could be better. It's really hard to know. But for me, these lenders are so fickle right now. Like, Bank of the West approved me, but just today they just said that, the underwriter, they changed their minds. They denied the deal, and then we're going to appeal. So how do you appeal the underwriter? What you do is you say, okay, the new loan was $525K, right? I'm all in for $470. That means I'm pulling out $50,000 on top of my down payment, on top of my renovation costs. I just said, all right, let me lower that loan amount. If they're concerned about my cash flow, they're concerned about my cash flow, right? The debt service coverage ratio must be greater than 1.2, and they do a stress test on your property. So I said, okay, let me lower my loan amount. What, $470? I'm fine. If you want to go down to $470, it's fine. A little bit less, I don't mind leaving money in the deal, right? Whatever. And what else I did was my rent roll increased. right? I went from 75% occupancy to 85. So now I have more cash flow. And if I lease out one more unit, today or tomorrow, I'll be at 90%. So I'll give them the updated rental and say, hey, my cash flow is better now. It's 8,300 versus 7,200. So just lowering your loan amount and increasing your rent roll, that's huge, right? That could get you to that debt service coverage ratio. And I have existing relationship with them. So they know me, they know my history with my 26 unit. So hopefully, fingers crossed, it goes through. But worst case, I just extend my hard money loan, or I got quoted another lender, same loan of 525K, but it's gonna be 11.5% interest over 30 years. So, I mean, I could technically pull out all my money, but at 11.5% interest, at that point, it's better to not have, the deal, right? You can, interest rate is supposed to be lower than the S&P 500, which is 8%. So 11.5, it's pretty high. So let's talk about the final numbers. So once again, I bought for 350, renovation 120, all in for 470. So the ARV at 700,000, I forced $230,000 worth of forced appreciation on this asset in 1 year, right? My rents were $550 per unit. If I use Bank of the West, once again, I pull up my down payment, renovation cost plus additional 55,000. That was my approval of a week ago, but it changed today, right? So today, maybe I can only pull up my down payment and renovation cost, or maybe I have to leave some money in the deal. But hey, if I left $50,000 in my deal, whatever, I spent $50,000 out of pocket to own a 20-unit apartment complex that's fully renovated. That's a good deal, right? If I use a local bank, same thing. Just pull up my down payment, renovation cost. So this is the reality. This is what I underwrote 1 year ago, right? So I'm being very transparent. I thought it would be worth $800,000, but I thought the loan terms would be 5% interest over 30-year AM. I did not expect interest rates to go up to, 7.5 to 11.5, which again quote today, right? And I thought I was going to cash out refinance $130,000 on top of my down payment and renovation cost, right? So $130,000 tax free is what I take home. What pharmacists take home, right? That's like pretty solid income. But because interest rates were a lot higher, my ARV went down, right? Because in order to hit that debt service coverage ratio of 1.2, if your interest rate goes up, your loan amount goes down to hit that ratio, right? So if my interest rate was literally 5%, I probably would have been right at around $800,000 for my ARV. But the fact that I appraised or getting valued at 700 with a 7.5 to 8% interest rate, I know I hit my number, right? So overall, what's the key lesson in this deal, right? You want to buy right of instant equity. So remember, I bought half with $50,000 instant equity, and I had the ability to force appreciation, right? So I'm all in for 470. I forced it to 700, which is $230,000 of equity, right? I thought it was going to be $330,000, but because I had such great margins, I can take a hit, right? The fact that interest rates went up, I can kind of take that hit. So, that's what I kind of teach in my YouTube videos as well as my mentorship is you can do this strategy in any market. Once again, I'm a little bit unlucky. Like interest rates are terrible right now. Like you read all the headlines, every time interest rates go up. Like I'm pretty agnostic to interest rates, but it kind of hits you when you're like trying to do your refinance, but it's out of your control, right? So I'm looking at, multiple options. Like if I don't want to extend my hard money loan, I have a bunch of lines of credits I can use to pay off this property, and I just pay my line of credit, right? So that's what I learned. So I kind of jumped ahead, but this is what I learned. So this is speaking from my experience in renovating, 45 units in 1 year. Renovation takes longer than expected and costs more than expected always, right? Hard money lenders can change their extension fees at any time. So when I first got my hard money loan, they said I can do a 3-month extension for free. And then a month before I'm due, I said, hey, can I get my 3-month extension? They said, oh, it's going to cost you 1.5 points, and we're going to raise your interest rates by 2.5%. Okay, they changed it. The scope of work. So remember, for my hard money loan, I got $100,000 for renovation, but they based that renovation off your scope of work. The problem is the scope of work is your best guess of renovation, right? But the reality is, when you start ripping out walls, you might find more issues. So if you have to repair those issues and it's not in the scope of work, you're not going to get reimbursed that money from the lender. So have reserves. Very key, have reserves, right? Once again, buy right, enforce appreciation. I hit that point earlier. Tenant turnover will turn over more than expected, right? Like, hey, I underwrite the deal. Maybe when you underwrite the deal, you think you're getting 8% cash on cash return. Well, the moment you take over, you lose 3 tenants. There goes your 8% cash on cash return, right? You have to constantly remind your property manager of your goal and be clear on which units should be renovated, right? Like, be very clear every week, however much is needed, right? I want to renovate this unit heavily with this, this, and this. This unit will be a basic turn, right? And then you want to ask your property manager, partner them, what can be done to rent these units faster? So they told me about move-in specials, right? They told me $77 move-in special, and I told them to advertise on Facebook Marketplace, right? So we learn from each other. That's the goal. And they know the market the best, and they know their tenant base the best. And, I just talked to my property manager today. She said that, oh my God, the new tenants are amazing. Like, they're no headache, no maintenance calls, and they pay their rent, for now.